In June 2026, one company did something no company in history had ever done. It became worth more than $5 trillion. That company is NVIDIA, the chip maker at the absolute center of the AI revolution. So today, we're doing a proper stock analysis. What NVIDIA actually does, the staggering numbers behind it, the bull case, the bear case, and how to think about whether a $5 trillion company can possibly keep growing. Quick note up front. This is education, not financial advice. First, what does NVIDIA even sell? In simple terms, the engines of artificial intelligence. NVIDIA designs the most powerful AI chips in the world, graphics processors, or GPUs, that train and run almost every major AI model on the planet. When a tech giant builds a new AI data center, the single most important, most expensive ingredient is usually a rack of NVIDIA chips. But here's the secret weapon. It isn't just the hardware. It's the software, a platform called CUDA that developers have built on for nearly 2 decades, and which makes NVIDIA incredibly hard to leave. And to appreciate this, look at how fast it happened. For most of its life, NVIDIA was known for gaming graphics cards, then crypto mining, then the AI explosion. In just a few years, the company rocketed from a $1 trillion valuation to over $5 trillion. That is one of the fastest creations of wealth in the entire history of capitalism. The whole story compressed into roughly 3 extraordinary years. Now the numbers, because they're genuinely hard to believe. In its 2026 fiscal year, NVIDIA generated $216 billion in revenue, up 65% in a single year. Of that, around $194 billion came from its data center business alone, growing nearly 70%. This is a company the size of a small country's economy, still growing like a startup. That rare combination, massive scale and explosive growth, is exactly why the stock has gone vertical. And $5 trillion is a number that's almost impossible to truly feel. So here's some perspective. That single company is now worth more than the entire annual economic output of countries like the United Kingdom or France. It is bigger than the combined value of most of Europe's largest corporations. When one stock gets this big, it doesn't just sit in the market. In many ways, it becomes the market, moving the major indexes with its every swing. So why are the bulls so confident? In one word, the moat. Competitors can design a fast chip. What they can't easily copy is CUDA, NVIDIA's software ecosystem that the entire AI industry has standardized on. Switching away from NVIDIA means rewriting years of work. On top of that, NVIDIA enjoys enormous pricing power and profit margins most companies can only dream of. When you're the only credible supplier of the most in-demand product on Earth, you get to set the price. Let's lay out the bull case plainly. 1. The AI build-out is still early. Hundreds of billions in data center spending is still being committed. 2. NVIDIA has a near monopoly on the best chips, protected by software. 3. It is still growing revenue at breakneck speed. And 4. And this surprises people. Even after the run, the stock isn't priced like a crazy bubble. It trades around 32 times trailing earnings and closer to 21 times forward earnings. For a company growing this fast, bulls argue that it's far from insane. But every great bull case has a shadow. The bear case matters just as much. 1. Customer concentration. A huge chunk of revenue comes from a handful of giant cloud companies, and those same customers are now designing their own chips to reduce their dependence on NVIDIA. 2. Competition is coming from AMD and from custom silicon. 3. Chip demand has always been cyclical, and booms have a habit of turning into busts. And 4. At $5 trillion, the company is priced for near-perfect execution. Any stumble gets punished hard. So is it expensive? Here's where it gets interesting. On the surface, a $5 trillion price tag sounds absurd. But valuation isn't about the size of the number. It's about price relative to earnings and growth. At roughly 21 times forward earnings while growing over 60%, NVIDIA is paradoxically not the most expensive large-cap stock out there. The whole debate comes down to one thing. Does the growth continue? If it does, the stock looks reasonable. If growth slows sharply, that multiple gets very expensive very fast. So what's the verdict? And to be clear, this is a framework, not a recommendation to buy or sell anything. NVIDIA is not a cheap, safe, sleepy stock. It is a high-quality, high-growth, high-expectation bet on one idea: that AI demand keeps compounding and its moat holds. If you believe the build-out has years left to run, the bull case is coherent. If you think we're near the peak of the cycle, the risk is very real. The smart approach is rarely all in or all out. It's understanding exactly what you are betting on and sizing it so a sharp drop doesn't break you. If you're tracking NVIDIA, watch three things. 1. Data center revenue growth. Is it still accelerating or quietly slowing? 2. The big customers. Are the cloud giants buying more NVIDIA or shifting to their own chips? And 3. Margins. Are they holding, or is competition finally starting to bite? Those three numbers will tell you whether the story is still intact, long before the headlines catch up. Here's the bottom line. NVIDIA is the purest, most powerful bet on artificial intelligence in the public markets. A genuinely extraordinary business, priced for an extraordinary future. The reward depends entirely on whether that future arrives on schedule. Whether it belongs in your portfolio is a question only you can answer. Now, everything in this video is for education and information purposes only. It is not financial advice, and nothing here is a recommendation to buy or sell any stock, including NVIDIA. Figures are estimates that may be out of date, and every investment carries risk, including loss of principal. Always do your own research. If this breakdown helped, subscribe to Innovana and tell me which stock to analyze next. I'll see you in the next one.